When you're developing a trading strategy, should you be focusing on increasing your win rate or increasing your risk to reward? Well, there is not a simple answer to this. However, I will guide you through the process of understanding where is this sweet spot in between having a high risk to reward and having a high win rate. Now, if you're new to the channel, I'm a top author on the TradingView platform and I share free education and analysis on all my platforms every single day. So I really do suggest that you subscribe to the channel so you won't miss out on all this free education, and I will see you in the video. In today's video, I'm going to explain to you guys a very important concept when it comes to trading as a whole. Why? Because if you don't understand this concept, you will have a very tough time in the market. Because I know that many of you are actually chasing win rate when actually you're supposed to be chasing risk to reward, and you're actually supposed to be chasing a strategy that has a minimum 1 to 3 risk to reward. And the reason for which you're supposed to be doing this is exactly what I will explain now in this video. So first, I will be explaining to you guys exactly the mathematical reason for which you're supposed to be chasing high risk to reward instead of chasing win rate, so high win rate. And then I will also show you a very good trade that we have been able to capitalize on EuroSGD lately with students for a beautiful 1 to 3 risk to reward, which is our minimum risk to reward for a trade, because you can try to understand some key concepts that you're supposed to be looking for when you're actually developing a strategy that has a minimum 1 to 3 risk to reward. So obviously there are many important things to learn in this video, so I suggest you stick to the end. Now, the first thing that I want to explain is this concept when it comes to having a high win rate, like 70% win rate, instead of having a 40% win rate, however, with a 1 to 3 risk to reward. And I will show you why this is actually a lot better. So let's start from a generic example. Okay, you have 10 trades, and in one case, you have a 70% win rate with a 1 to 1 risk to reward. And in the other case, you have only a 40% win rate, which means that you're actually losing way more trades than you're winning, because over 10 trades, you're actually losing 6 trades and you're only winning 4. In this case, you're winning 7 trades and you're only losing 3. So why is this a lot better? Why in this case, even if you have only a 40% win rate with a 1 to 3 risk to reward, it's still much better than having a 70% win rate with a 1 to 1 risk to reward. Now, for those of you that don't know what risk to reward is, it's basically what you are risking compared to what you're gaining. So a 1 to 1 risk to reward means that if you risk 1% on a trade, you will gain 1% if your trade will be a winner. On the other side, if you have a 1 to 3 risk to reward, it means that if you're actually risking 1%, you will make minimum 3% if the trade will be a winner. So for example, in our trade, we risked 38 pips to make 116 pips, which is a 1 to 3 risk to reward, because if we win, if the trade will be a winner, we will make 3 times what we have actually risked. Just a general concept. So if you have 10 trades and you win 7 and lose 3, how much did you gain? Now let's take, for example, that you are risking 1% per trade. Now you will have win 1% 7 times. So 1 times 7 is obviously 7. So you have a 7% profit. Then you lose 3 trades because, as we said, 70% win rate. So we have to take away the 3% loss that you had, because 3 trades ended up being a minus 1% loss, therefore leaving you with a 4% overall profit by having a 70% win rate with a 1 to 1 risk to reward. In this case, however, you only win 4 trades out of 10. So you lose 6 and you win only 4. What happens? Now you have 3% because it's the minimum win. When you win 3%. When you lose 1%. So 3% times 4 is 12% profit. However, you lost 6 trades. So you have to subtract. That is 6% loss, because when you lose 1%. When you win 3%. So 12% 6% profit minus the 6% loss leaves you with a 6% profit. So by losing more trades than what you actually are winning, you made more profit than in this case where you won way more trades than what you actually lost. And this makes you immediately understand how powerful risk to reward is over win rate. Win rate is not that important. Risk to reward is what is actually important. Because if you have a minimum 1 to 3 risk to reward, you can even only win 3 trades out of 10. You can win 3 trades out of 10. So you lose 7 and you win only 3 and you're still in profit. Why? Because 3 times 3 is 9. While you lost 7 trades, you only have to subtract 7. So 9 minus 7 is 2. So you are in profit even though you only won 3 times out of 10, which makes you easily understand that it's almost impossible in the long run to be non-profitable if you have a strategy that has a minimum 1 to 3 risk to reward, which is what we have with our strategies. Our minimum risk to reward is 1 to 3. Now let me give you a full breakdown of the situation that we had when we executed our short position on Euro SGD with students. What did we actually have when we executed that trade? So to understand what we had, let's first go back and use the reply tool to understand exactly the situation that we had when we executed the trade. Just a quick reminder, make sure you comment below and you let me know which pairs or topics you would like me to analyze or cover in the next videos. So let's start our analysis from the monthly time frame. Now on the monthly, what did we have? We had a market that clearly had provided a nice impulse to the upside. And after an impulse, what do you want to see? You want to see a correction. Specifically, you would like to see the market create a correction at least to retest the previous resistance, which is now turned support from a monthly perspective in this case. And the previous resistance, now turned support, is exactly this red candle here. Why it is this red candle here? Because this is the last time that the market went to the downside before starting this strong impulse to the upside. Therefore, it is the previous resistance, which is now turned support. Going down on the weekly, what do we see? Now, from a weekly perspective, we can see a very important thing. In fact, we consider the market has created a triple top at this area, failing to continue higher and starting the monthly retracement that we wanted to see in the first place. And what we can also see is that the last weekly candle has this shape. Now, if you see a candle like this, okay, with a body, which is half the size of the wick, or better said, the wick is at least big as much as the body. What you expect with the next candle is the market to fill in this wick. And that is exactly what we have here, the pattern that we have spoken about many times. I also made a YouTube video just about this pattern. So we definitely do expect the next candles to fill in this wick and go and test the monthly support as we have already identified from a monthly perspective. Going down on the daily, what do we see? Now on the daily, we can see one very important thing. On the daily, we could see with students that the market was clearly retesting a very strong level of structure. In fact, we had structure support here, against support here, against support here, against support here, and the market had broken below this very important structure with this strong impulse. And all this previous support was turned resistance inside of this area from which we expected a rejection to the downside and the completion of this daily impulse correction and impulse pattern to the downside. We also had confluence of resistance inside of this area. In fact, taking our Fibonacci from the high to the low of this impulse, we could see that clearly we had a 50% Fibonacci confluence exactly inside of this structure. So 50% retracement lining up perfectly with all this previous support, now turn resistance in this area, creating a confluence of resistance inside of this zone from which we expected a rejection to the downside. So monthly, weekly, and daily all indicating for a nice move to the downside. And what did we have from a COT perspective? Now these tables are the COT data, which is the commitment of traders. So what hedge funds are currently doing in the market. And obviously it helps you gain an advantage over your competition in the market. And what we could see on the euro is that hedge funds were taking their profits on the euro longs. In fact, what they were doing in the past is adding a lot of longs on the euro. We went from having minus 114k net positions with 271k shorts and 157k longs, so way more shorts than longs, to having a situation where we had way more longs than shorts, with 262k longs and 50k shorts. So massive longing on the euro. And in fact, we already seen this reflected in the huge uptrend that was developing on euro pairs. However, what was happening lately is that hedge funds were closing tens of thousands of long positions, therefore taking their profits on the longs, meaning that we could definitely expect some euro weakness for a rejection to the downside, as we have already seen from a technical perspective. So with students, we were able to execute a perfect trade to the downside for a beautiful 1 to 3 risk to reward, which is exactly the minimum that we are looking forward to capitalizing on with our strategies. Now, obviously, I cannot share exactly why my entry is here, why my stop is here, why my take profit is here. That is part of the mentorship program. A couple of basic technical analysis things that I can share is that clearly we had previous resistance here, which is again resistance here. That is the only thing that I can share. Take profit at the -27, but obviously that is not enough. Okay, structure is not enough to execute trades. You will not be profitable in the long term if you just trade structure. So obviously we have way more entry rules when it comes to finding confirmations for our trades, but that is part of the mentorship program and I cannot share that. However, I hope that these concepts when it comes to risk management, risk to reward, and probabilities, and also these technical concepts when it comes to understanding how to build high probability setups with high risk to reward was somehow transmitted to you and that you did learn something in this video. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find it linked in the description. You first learn all the rules of my rule-based strategies in the program, and then you trade them live with me. In fact, every single day you get a new daily market breakdown showing you exactly how to apply the strategies with entry, stops, take profits, as well as having me answering every single question that you have every day, including the weekends. So I really suggest you go and check it out. The link is in the description, and I will see you in.